episode 13. This week we're going to be discussing what's the deal with SPACs. So, the one hot topic of 2020 has really been SPACs. And if there's one part of the venture ecosystem that may very well be in a bubble right now, it's the SPAC world. And we've had actually many of our portfolio companies SPACing, companies like Porch or Opendoor. But I guess it begs the question, what are SPACs? How do they work? And are we in a bubble? Why are they so hot in 2020? And to present that and to explain what they are, how they work. We have our, resident venture boy, perhaps now to be renamed resident SPAC boy, Jeff Weinstein. So I'll hand it over to him.
Thank you, Fabrice. Hi, everyone. My name is Jeff Weinstein. I co-head the FJ Labs investment team, and I am here to give a talk about SPACs. Quick background on me. I've been at FJ for 4 years now. Prior to that, I was an associate at Lux Capital. I was there for 4 years. And before that, I come from a finance and economics background. So I studied finance and economics in undergrad, and I worked at a fund of hedge funds for 2 years after that. So as you know, SPACs, as you probably know, SPACs have been, actually, let me start with a disclaimer. First of all, I am wearing my venture capital hat when I analyze the SPAC phenomenon here. Nothing here is investment advice. Please do not consider it as such. These are my views only. These are not representative of FJ, nor are they any other form of financial and trading advice. So just here be warned, okay? So on that, let me tell you a little bit about what's going on this year. So I'm sure you guys have heard the term SPAC. You may not know what it is. You may not know what it means, but they are everywhere right now. They are dominating the financial markets, and they are a exciting new alternative to the traditional IPO process. So to give you a sense of how much SPACs have exploded this past year, you can see here that just through October, SPAC issuance has more than doubled from 2019, which was already dramatically increasing. In fact, it almost has tripled, and it's gonna more than have tripled year over year. And there are some very important heavyweights who are actually involved in this. This is not just random boiler room pump and dump shops anymore, like the SPAC had the reputation for in the 90s. So if you see on this picture here, you see on the top left Bill Ackman. He's one of the most well-known hedge fund managers of our time. On the bottom left, you have Chamath Palihapitiya. He was formerly at Facebook. He ran Social Capital, and now he manages his own family office. And he is one of the big proponents of the SPAC. And then on the right, you actually have my alma mater, Lux Capital, who has now raised a SPAC of their own alongside a number of other prominent venture capital funds. So what is a SPAC? SPAC stands for Special Purpose Acquisition Company. You might also hear it referred to as a blank check company. This instrument was first invented in the 90s. I touched on this briefly, but it originally had a very sketchy reputation. The reason for this is that it was typically an instrument used by sketchy small firms to very quickly pump and dump underperforming companies. And so for a very long time, this instrument was used to take fraudulent companies public, grab investor money, and sell to an unsuspecting public. Now, whether or not that's still the case, we're going to discuss going forward. But I can tell you that top tier banks and top tier funds are now involved. So whether or not retail investors are still getting dumped on, there are very prominent players now involved in the SPAC scene, and that was not the case. So what is a SPAC? So a SPAC is a blind pool of capital that is raised by an organization, and it is raised via an IPO. So you go out, you basically say, I am a great operator. I am a proven founder. I'm a proven private equity manager. I'm a proven VC. I am going to go find a private company and take it public. And investors are backing you. They're backing your brand. They're backing your roster of operators or board directors that you assemble. And they give you money to go take public a company. And this is done through a reverse merger process. So what happens is you raise, it's typically around $200 million. You raise $200 million, you take that $200 million and you go invest it into a private company. And through the act of investing into that private company, you merge it with your publicly traded vehicle, and that private company now goes public. And the key is that this is a blind pool of capital. Investors cannot know what they are investing in when they invest in your SPAC. And as soon as you raise the SPAC, it trades on the market. So you can go out and you can buy SPACs. They typically list at $10 a share. That's just kind of the practice at the moment. And they typically trade around $10 a share because nothing has happened yet until they find a target. And then at that point, they might move up or down. And I'll get into the mechanics of that later. And one of the other important elements of the SPAC, which will be relevant later in this talk, is you have to use it or lose it. You raise a SPAC and the clock starts ticking. You have 2 years to find a target. And if you don't find a target within 2 years, you have to give the money back to investors. So this is a little bit complicated. If you guys have any questions, feel free to enter them in the chat and Fabrice can interject if need be. I'm going to try to simplify it and walk it through for you guys because it is very fascinating. So I'm not going to talk through every step here, but this is the process. I basically described it a bit. You decide you want to form a SPAC. You go on a roadshow that's typically run by bankers. You go talk with hedge funds. You talk with ultra high net worths. You talk with private equity funds. You try to get them to invest in your SPAC. You go public. Your reward for making the SPAC yourself is you get to keep 20% of the shares. I'll get into the math on that, but that is crazy. That's amazing. And this is part of the reason the phenomenon is exploding. After you raise your money and your SPAC is trading, you start hunting. You start hunting for targets. When you find a target, you start negotiating what price you think the company is worth. And then your shareholders, you come to an agreement, and then your shareholders vote whether or not they want the transaction to go through. If they vote yes, it's just a simple majority. Then you can proceed with the transaction. And you take the money that you raised minus the 20% that you get to keep, the shares, and you inject it into the new company, and the merged company begins trading. So this is a big contrast to the normal IPO process, where imagine you're a DoorDash and you're going public. You go on the roadshow yourself. You have to go talk to each individual investor. You don't know where you're going to price. I'll actually wait for a little bit to describe exactly the company perspective. This came from an interesting CB Insights report, by the way, called What is a SPAC? If you'd like to get a little bit more granular, I recommend you check that out. Why now? Why 2020? Because this is not a new vehicle. This is not a new approach. Well, this is my opinion. There are two reasons. One, stock market is ripping. The quote unquote retail bros led by my folk hero in the top right, Dave Portnoy, Davey Day Trader. There is an army of millions of Robinhood bros who are perusing the subreddit on the bottom right, Wall Street Bets, who are basically treating the stock market as a casino. And by the way, they've been making a lot of money doing so. So you can laugh at them all they want, but the way things are going phenomenally well for them. We have record low interest rates, unprecedented amounts of global fiscal stimulus, particularly U.S. fiscal stimulus, has led to absolute, let's call it, I call it a euphoria. Some people can disagree, but very ebullient public markets. And you can see multiples expanding across all of the public markets, particularly in tech, where you're seeing public markets way surpass private market valuations. And you're seeing, particularly in industries like SaaS, where it's not uncommon now to see SaaS companies trading at 20 times revenue, which is a number that would have blown the mind just 1 or 2 years ago. So you have retail bros, as I'm going to call them, who are looking to find exciting new stocks to buy and effectively gamble on. And you have a voracious appetite for new issuings. And that's why you're seeing the IPO market explode and you're seeing the SPAC market explode. Now, there's another reason, which is that there's been a secular decline in the amount of publicly listed companies. The exact reason for this, people continue to debate. I personally think a lot of this comes to just regulatory friction. Ever since the Sarbanes-Oxley Act, after the 2000 crash, you're seeing it's a lot harder from a regulatory and compliance perspective to go public and to be public. And so it's become less appealing. And that also explains the explosion in late stage unicorns, which may have gone public early in their life a long time ago. So you have fewer public companies, you have more demand than ever. So you have, it sounds like it's time to create some more supply. Now, I talked a little bit about this, but from a sponsor perspective, a SPAC is incredible. You only have to put down typically 2% of the IPO raise. So if a SPAC is raising $100 million, you as a sponsor can put down 2%. And by the way, a lot of sponsors will actually borrow to do so. You only have to pay a nominal amount, typically $25K. And upon a successful merger taking place, you get to keep 20% of the shares. So what does that mean? If you raise $100 million and you successfully reverse merge with a company, they call it de-SPACing. There's got to be a better name for this, but that's actually what it's called, de-SPACing. You've put down $2 million and you're getting back $27 million of shares at the merger valuation, which means that even if you merge with like a junk company and it drops by 90%, you're still making money. So now you understand the incentives when you see some of these crazy SPACs, the crazy valuations taking place. It's really hard for the sponsor not to do well. And remember that ticking clock, 2 years. So there's a lot of incentive for sponsors to find targets. We're going to touch on this later. Now, what I'm describing is the norm in the industry, but things are starting to change. This year, Bill Ackman, Pershing Square, one of the most well-known hedge fund managers of our time, raised a $4 billion SPAC with no promote. His hedge fund is putting in $1 billion of the $4 billion, and the economics are aligned differently. So he's not getting that effectively minimal risk 20%. Now, it's going to be really interesting to see what happens there. The bet is that he's going to be able to take an exceptional company, like a Stripe, for example, public. That'll be really interesting to see. I touched on this a little bit. This is a really interesting person you can follow on Twitter if you want to get, again, more granular on SPACs. The $113 billion of outstanding SPACs looking for targets, if you're taking that 20%, we're talking about $23 billion of compensation to the sponsors. The truth actually is that what he's not factoring in is that there's no ongoing management fee for SPACs. So private equity and venture capital, you get to charge 2% a year on top of 20% carry. So don't get me wrong, SPACs are amazing, but PE and VC are good asset management tools as well. From a company perspective, why does a company agree to merge with a SPAC? Well, there are a couple reasons. Speed and certainty is one of the most important ones. It takes years to prep for a traditional IPO. As I mentioned, the regulatory and compliance burden is very, very high because the SEC wanted to protect retail investors from the mania of 2000. SPACs can go public. The entire SPAC process can be 3 to 4 months. If you're a company, when you're negotiating with a SPAC to go public, you have one counterparty. You're not doing a whole roadshow. You're negotiating with one firm. That firm has basically done the roadshow beforehand. So you're just dealing with a Bill Ackman or a Blackstone or an Apollo. They are your counterparty. And you actually, there's an interesting element to that, which is that that person can either be strategically relevant or they can add brand credibility. Chamath Palihapitiya, I talked about him before, super well-known operator, very promotional guy. He took public Virgin Galactic, which is a consumer-facing company that seeks to offer consumer space travel in the future. He took on the chairman role, and his promotional behavior has certainly been helpful for this stock, which is very appealing to the retail investor. And so you can offer, as a SPAC sponsor, you can offer strategic, operational, advice, domain expertise, and it can be true. Imagine you're raising imagine you are taking public a sports company and you have Michael Jordan involved, as Michael Jordan is involved with DraftKings. It's compelling. It's interesting. But I think one of the most important, if not the most important elements of the SPAC is the ability to offer forward guidance. Now, what that means is when a company typically goes public, they have to publish all their historical financials, and then they enter a quiet period. They're not allowed to talk about the company. They're not allowed to explain future aims. They're not allowed to add nuance and storytelling to the IPO. They have to basically just rest on those public financials. SPACs are not like that. With SPACs, you can tell your story. This matters a lot if you're a deep tech company and you don't have recurring revenue like a SaaS company, and you can't just say, hey, here are my 2018 financials, 2019, 2020, and you can't basically let people extrapolate from your previous financials. Imagine you're a 3D printing company. Desktop Metal is a Lux company that recently came public via SPAC. So much of that comes down to the tech innovation, the strategic partnerships, and you can't explain that in a typical IPO process. So with SPACs, you actually are allowed to educate investors in private. You can walk them through the story. And so that's really powerful for the frontier tech companies, for the frontier tech companies that don't have this recurring revenue, that can't just sit on their historical financials. And by the way, that's why you see that an overwhelming number of these companies that are going public via SPAC are frontier tech companies. Whether or not they're good investments, we'll talk about a little bit later, and my thoughts there. Last but not least is price discovery. If you look at what happened just recently with DoorDash and Airbnb, they had that vaunted IPO pop, but the IPO pop, they doubled, which if you ask someone like Bill Gurley, it means there was a ton of money left on the table. It means that these IPOs were dramatically mispriced and the bankers didn't do their job well. Well, if you're a company, you get to go talk to 5 different SPACs and see what the market is telling you. You don't have to worry about that IPO pop or that surprise when the IPO takes place. You get to determine yourself. You could literally shop around, do some price discovery, and then pick your price. One other thing I'd want to talk about is WeWork. It's almost tragic. Had WeWork waited a year later to try to go public, they would have been the perfect candidate for a SPAC. And I actually bet they successfully could have gone public via a SPAC. So that's a perfect example. And by the way, going back to retail investors getting fleeced, fraud, pump and dump, yada, yada. Like, again, I'm not going to say it, but you can imagine like WeWork being a great SPAC candidate kind of makes sense for this conversation here. So this came from a really good blog post by John Luddig at Founders Fund, another piece of material. If you want to get more granular, I recommend you read. This talks about the different upsides and downsides of different exit options. And what you can see here is that the SPAC is actually quite appealing. So it's fast, 4 to 6 months, flexible diligence. Each SPAC is bespoke. So you actually can customize a lot of those things I described. That 20% promote is the industry standard, but it's going to come down as it gets more competitive. And it's negotiable. You can negotiate secondaries. You can negotiate earnouts. Founder management typically gets to stay in place. I mean, almost always gets to stay in place. Sometimes you might have 1 or 2 management changes as part of the de-SPACing, but management gets to stay in place. Low execution risk, high certainty, pricing accuracy I talked about. And almost any startup can do it. Whereas a direct listing, you typically want to be more consumer focused, like a Spotify, and you have more consumer appeal. Now, this is really interesting. So I talked about the company perspective. Institutional investors, and when I say institutional investors, I'm talking the quote unquote smart money. I'm talking hedge funds. I'm talking crossover funds. I'm talking like the Wall Street sharks. Believe it or not, they are the people who are the most excited about SPACs. And the reason for that is that the way the SPAC is structured is it creates that unit arbitrage. Arbitrage is a risk-free investment. It's effectively free money. How does that work? So when you invest into a SPAC, you are investing in this blank check vehicle. As part of the investment, you get 2 things which are great. You get warrants which allow you to purchase more shares at a preset price. So for example, we talked about $10 being the typical listing price. With warrants, you have the right to purchase more shares at $11.5 a share after the de-SPAC. Why is that amazing? Well, if you look at what's been happening with SPAC prices after the de-SPAC, they are typically soaring. QuantumScape 6x'd in price in the past month after they announced their de-SPAC. So what that gives you the chance to do is if QuantumScape is trading at $60 a share, you can buy shares at 11.5 and immediately flip them for 60. So it's an incredible piece of optionality for these investors. But that's not the best part. The best part is that SPAC investors can redeem whenever they want, if, particularly at the time of the merger decision, for at cost plus interest, although minimal. Interest rates are low, but they keep the warrants. So imagine you're a hedge fund like Millennium. You have a place where you can park your money. You put your money in the SPAC. You're earning minimal interest. And at the time of the shareholder vote, you can redeem and you get to keep the warrants. So you're getting warrants and minimal interest for free. It's literally a risk-free investment. And so there's a really interesting paper that was jointly published by Stanford and NYU Law School, which shows that the typical SPAC investor that redeemed their share, which means they put their money in and they decided, no, we don't want to vote for this merger to take place. We're going to take our money back. They earned 11.6% at no risk. It's incredible. So now you can understand why this is such an appealing product for institutional investors. And to that point, the typical SPAC nowadays is getting 3 to 4 times oversubscribed because of the Millenniums and the Citadels of the world, these sophisticated hedge funds who are basically taking every dollar they can. And by the way, these hedge funds are short-term in nature. They are obviously not aligned with the sponsor. They're not aligned with the company. If you look at the redemption rates in the 2019 to 2020 merger cohort, you can see that the typical IPO investor in these SPACs is redeeming. Now, what does that mean? It means that you basically need to raise more money to make up for that redemption. And we'll talk about the PIPE in a little bit, but it's very important that you work with sophisticated bankers to make sure that they don't blow up your investment in this manner. But just keep in mind, if you're a company, you're partnering with a SPAC, that IPO is filled with sharks. So it's something to think about not having the same long-term shareholder base that you might if you raise a traditional IPO and you get to interview and speak with each of the crossover funds and the hedge funds who you know are aligned for the long term. From the retail bro perspective, the pitch is access. When else can you get to bet on Bill Ackman? You can't get access to Pershing Square. I mean, some of these hedge funds, they might have some publicly listed vehicles. You get access, for example, Firstmark, which is one of the best funds, if not the best fund in New York, who we work closely with. They have a SPAC. When else can you get to bet on Rick Heitzman at Firstmark, one of the great New York investors who backed Airbnb and Pinterest? With this, you get to invest in Rick Heitzman. You get to invest in Lux. You get to invest in Dragoneer and Altimeter. That's pretty cool. And you know that these guys are in it for the long haul. They're not just trying to make a quick buck. They don't need to do this. Their reputation is everything, and they're not going to just try to like pull a quick one on you. So there is that argument, and like I actually own a tiny amount of Firstmark SPAC. But frankly, if you look at Wall Street Bets, if you look at our SPACs, the vast majority, in my opinion, of retail bros are just like gambling. Stocks only go up, YOLO, Davey Day Trader, and that will explain some of the SPACs that I'll talk about in a little bit. And by the way, it's not irrational the way they're acting. DraftKings went public via a SPAC, and the business, granted, they had the massive tailwinds of the Supreme Court legalizing sports betting, but look what's happened to their stock. I mean, it's up 5x It's now a $20 billion company. And so you can, de-SPACed companies, they can perform very well post-merger. Opendoor. I mean, Opendoor is up. I think it's trading at $25 a share, which is a 2.5x step up from what the valuation that Chamath negotiated. So I'm not saying that like you're going to get hosed as a retail investor, but there's certainly like a healthy amount of buyer beware, and just like be very, very cognizant of the product that you're investing in. One more thing I would be remiss in not mentioning is that almost every SPAC now comes along with a PIPE. A PIPE is a private investment in a public entity. This is basically what happens here is that when Chamath takes Opendoor public, he knows that his IPO is going to be filled with those sharks, with the Millenniums, with the Citadels, with the Third Points of the world, and he knows that those guys are making this risk-free money, and that they're not necessarily long-term oriented and aligned with Opendoor. So what do you do to stabilize the business and to make sure that it's actually set up for the long term? Well, you separately raise another private round that goes into the deal at the same terms. So you go and you find like a Wellington and a T. Rowe Price and maybe a Coatue, and you get a very respectable set of long-term oriented investors who come in and they invest at the same terms. So they invest at that $10 a share, and they can be used to backstop any of the redemptions that take place by the sharks who decide to pull out and not do the transaction. So a PIPE is a very important signal to the market that we have long-term investors here who are not in it for the quick flip, that they want this company to succeed. It gives the company additional money. And one thing that I have not touched on yet, which is really important, is that they help defray the costs of the SPAC transaction to the company. And so I can touch on that now here. SPACs are really, really expensive. And the reason for that is that the company is eating not only the traditional banker fees, which you have in an IPO, you're paying about 5% to the bankers, but then you're paying the 20% to the sponsors. So if you do the math, you're paying 25% of the money raised in that SPAC. That is a lot when the typical IPO is about 5 to 7%. Now, if you raise the PIPE, and typically a PIPE is as big, it's actually usually bigger. If you raise a PIPE that is double the size of the SPAC, if you take that total amount of money raised, knowing that the PIPE does not come with that 20% promote, the PIPE is, it might come with a very, very small banker fee. But if you take that same 25% and you basically divide it by 3 because you have a PIPE that's double the size that is sticking onto the SPAC, now you're talking with something like an 8% blended cost of that investment. That makes it far more in line with the IPO. So PIPEs are good because they help defray the overall cost of the investment, and they give you long-term aligned capital to make sure that the sharks aren't putting your company in jeopardy. I've touched on this a little bit, but here is the concern with the SPAC. You have over 200 SPACs that are currently looking for merger targets. They're all on the clock. The best companies are still going public via IPO or direct listing. We saw that with DoorDash. We saw that with Airbnb. We saw that with Snowflake Computing and Palantir. SPACs have not yet shown the ability to take public elite unicorns. Adverse selection is real, and it's happening all around us. The companies in our ecosystem that are being SPACed, frankly, they're not our superstar companies. And I don't think it makes sense right now for a superstar company to pay these type of fees and to not go the traditional IPO route. Sorry, 1 second. Okay, much better. The current fee structure doesn't make sense. SPAC investors are the ones who go in the IPO are typically these short-term hedge fund sharks. IPOs are still the preferred route. So what does this mean? I told you that the SPAC sponsors are going to make money on the deal, even if it goes down 90%. So whether they try to or not, they're going to give in to these incentives, and they're going to take public B plus companies, B companies, B minus companies. They need to get that deal done. And so what does this mean? Well, it basically means that if you're a retail bro, you're not seeing our best. You're getting dumped on, frankly. There are exceptions. I talked about DraftKings, but as a whole, and I'll get to this, SPAC returns are trash, and that doesn't mean that the product of like the SPAC as a tool isn't really interesting. But what it means right now, in the way it's structured, it means that it's buyer beware to the extreme. So I've touched on this, and I can probably go pretty quickly, but why not a SPAC? It's super expensive. I just talked about that. You have the short-term minded investors in the IPO. Institutional investor, there's no reason not to do a SPAC. It's free money. If you're an institutional investor, you should do every SPAC. As long as you know that the money's being put in these treasury funds, which they are, as these are run by prominent tier one banks now, do every SPAC you can. If you're a sponsor, well, it really depends. And this is why the quality of the sponsor really matters. If you're Blackstone, you're not going to get rich quick on one SPAC because you have a massive reputation to protect. I would say the same with Bill Ackman. If you're like Joe celebrity athlete, or if you're like some rando, yeah, a SPAC is a get rich quick opportunity, and I get it. But you should think of that as a retail investor. What are the incentives of your SPAC sponsor? Do they have a chance to get rich quick? They might be fleecing you. And I just touched on this, but here, the returns. The Stanford and NYU Law School study, A Sober Look at SPACs, highly recommend you guys check it out. They looked at this most recent SPAC cohort, and they looked at the short-term returns. It is ugly. The 12-month returns, and by the way, they divided this into high-quality sponsors and non-high-quality sponsors, and I think they used a lot of the logic I just mentioned. Look, what is the reputation of these sponsors? Is it Blackstone, or is it Joe Get Rich Quick? Is it someone who is already an ultra high net worth and has a reputation to uphold? Or is it someone who this could be a life-changing sum of money if they complete even a mediocre transaction? So you can see there is a massive difference between the high quality and the non-high quality SPAC sponsors. But even the high quality SPAC sponsors get crushed compared to the IPO index and the Russell 2000. And the non-high quality ones, I mean, you might as well just like I don't know, gamble on Robin. I guess you are gambling on Robinhood like this, but just like, I don't know. You got to find a more fun way of losing money, I swear. They did it over the long term too. And this is the 1 year post-merger returns by SPAC class compared to the Russell 2000. Just carnage, total carnage. So that's why this mania has to end at some point, because retail bros are going to wise up. And if it's a medium-term, long-term money-losing proposition over time, the appetite will dry up. Now, again, there are times when SPACs do make sense. Desktop Metal is a perfect example of that. That is a very serious company with very serious investors. The internal investors are not exiting anytime soon, as far as I know. Serial entrepreneur, I think Rick Fulop, I think this is his fourth or fifth company. Really groundbreaking technology. QuantumScape, this is an interesting one because I believe it's really interesting breakthrough technology, but this is the one that 6x'd in valuation after they announced the de-SPAC. So this business is it's electric vehicle battery technology. Well, it's battery technology that the vision is to be used for electric vehicles, and it's backed by some superstars. But the interesting thing is that this business they're not going to have revenue in the best case scenario for another 5 years. The tech is totally unproven. The commercialization is totally unproven. This business has I would call it, my friend is a battery expert, so I'm using a lot of his knowledge here, but he thinks there's a sub 5% chance of this business succeeding. It's trading at a $30 billion valuation. They're projecting zero revenue until 2025. So Whether or not that's a good investment at this price is a different story. But you can see these are the type of companies that a SPAC makes sense, where you actually have a groundbreaking technology. You can explain that to investors, but you can't just show people your financials and expect them to understand anything from that. Nikola is probably the funniest, most obvious fraud of 2020. This was the electric/hydrogen powered truck company, the wannabe Tesla, if you will. It's an obvious fraud. The chairman is out. It's been proven as a fraud, and yet it's still trading above the SPAC, the DSPAC price. It's trading at a $6.5 billion valuation. So if someone can explain that to me, I would love to learn. Frauds are, I mean, you're seeing frauds and craziness galore in some of these electric car companies SPACs. So I can't emphasize enough, buyer beware, buyer be like super, super, super skeptical. The vast majority of these SPAC companies are trash. Now, one question I was asking as I was doing my research is I'm making the pitch on behalf of these frontier tech companies who can offer forward guidance. But if you think about it, there's been an incredibly healthy pipeline of biotech IPOs for a long time. Last year and the year before were great for biotech IPOs. Why does this not apply here? I think the answer might be clinical trial data. You can actually demonstrate, you can have the crossover funds and the biotech funds like digest clinical trial data. You might not have that the same way with 3D printing or batteries or trucks. Perhaps like research papers aren't as rigorous or as definitive as clinical trials. So maybe it's still a riskier prospect. So that was something I was just asking myself. The other type of SPAC, which makes sense to the other type of company that makes sense to go public via SPAC, is something that has strong consumer appeal, like a DraftKings. Millions of people are playing fantasy or they're gambling on DraftKings. Or Virgin Galactic. Everyone thinks space is super cool. Space tourism is super cool. Richard Branson is cool. So you can see why consumers are eating that up. But again, whether or not that's a good investment, who knows? This is a crazy one. There's a company which is a pre-revenue company that grows tomatoes. It's an indoor farming startup called App Harvest. It has Martha Stewart on the board, J.D. Vance from Hillbilly Elegy, and a couple other random people. They have no clear public comp. How do you value an indoor farming startup? Well, according to SPACland, you value it at $3 billion plus. So again, make of that what you will. Now, this is what everyone is waiting to see, and I think this is why the serious players are involved in the process. It does make sense, hypothetically, from an elite company perspective, to go public via SPAC. You get to partner with an incredible operator, like a Reid Hoffman, who has a SPAC, a Bill Ackman, who's an incredible hedge fund investor. And the fees are negotiable, and you could see the promote going down. Like Bill Ackman's taking no promote. So there is a world where elite companies go public via SPAC. But again, this is potentially. This has not happened yet, and this is why there's so much skepticism among serious investors about the SPAC. But there are real players who are participating now. General Catalyst launched a SPAC. They're actually calling it a sale. Remember, each of these vehicles is bespoke. You can customize the economics, you can customize the terms, and you can make it very, very aligned. Lux has a SPAC. Dragoneer, who's and Altimeter, they're two of the great growth firms in the industry. They both have raised SPACs. Ribbit, probably the best fintech firm. First Mark. So like very, very, very serious funds are entering this, and they wouldn't be doing so unless they saw some real potential here. Now, what's their argument? Well, First Mark currently can fund people from pre-seed all the way till growth. They have a growth fund. Same with Lux. And now they can say, we can fund you all the way from seed to IPO and beyond. We are a true life cycle investor. We can support you forever. If you're a VC, you have asymmetric information when it comes to these private companies. You know these companies best. You have the best pattern matching skills. You have the best industry knowledge. You know the lay of the land way better than these random SPAC managers. You should be able to run laps around them. So it does make sense that the VCs who live and breathe the industry should be the ones who have an advantage in doing these SPACs. Now, the big question, and one I have not seen answered yet, is if you're a VC, can you take one of your own portfolio companies public? And that's a really interesting question. And from what I've studied, it looks like the answer is there is big conflict of interest risk, but it can potentially be mitigated. If you recuse yourself from the decision from the portfolio company side, if you recuse yourself from the board on both sides, it's possible. But again, it seems that there are a lot of landmines with this type of transaction, but I think a lot of VCs have this in mind because they can see what the optimal targets are in their portfolio, and they have this asymmetric information. But the key to remember is that you cannot know when you raise a SPAC what company you're taking public. It's illegal. You cannot. So if you're a VC, if you're a first mark, you can't raise a SPAC saying, "Oh, I have this great growth stage company. I want to take it public." It has to be truly a blind pool of capital. Another interesting reason that VCs might like this is that I talked about how incredible the sponsor economics are. If you're a Lux Capital, what you do is you make your fund serve as the sponsor. And so imagine Lux Venture 6, I think that's the name of their latest fund. They serve as the sponsor. Just look at these numbers here. If you sponsor a $300 million SPAC, you only have to put down $6 million, and you're getting $60 million of promote for your fund. And you can have that 10x upside. You can have a fund returner off of minimal capital at risk by sponsoring a SPAC. Think about what that does to your IRR and your multiples. So it makes a lot of sense to have a fund sponsor a SPAC. You're putting, a $6 million investment for a $500 million fund. That's not even a core investment. And so, but you have the chance to really earn outsized returns there. So pretty interesting. I've given you a lot of my takes so far, but I'm going to summarize it here. We are in a SPAC mania. I don't know how else to describe it. Most of these companies are trash. They're pump and dump schemes, particularly like in the electric vehicle and battery space. Like I talked about this Nikola $6.5 billion valuation. What are you guys doing? It's just insane. QuantumScape, same thing. Interesting technology, but this business is probably worth $1 billion, not $30 billion. Retail bros are getting dumped on, and they're going to get hurt. And frankly, I know the SEC is already looking into this, but when this slaughter takes place, I expect them to step in and regulate this industry because right now it's the Wild West out there. Trevor Milton is out there using shares of his he's using Nikola shares to buy $30 million houses while he's faking truck demos. So like it is the Wild West, and frankly, there probably should be more regulation to protect retail investors who don't know what they're doing. So I expect there to be a bit of a. I expect this bubble to pop. I expect retail investors to get hurt. I expect the SEC to step in. However, I also think this model is here to stay. And out of this carnage, I think there will be a new sustainable way to go public. And I think that over time, these fees will compress. There will be more competition in the market. I think that it's very logical for VC firms and PE funds and superstar operators to raise these SPACs. I think there is a massive opportunity set of late stage unicorns. There are over 500 that are going to want to go public, many of which are going to want to go public. And I think that some elite companies, we haven't seen one yet, in my opinion, but I do believe some elite companies will go public with this model, and they will partner with the right sponsors and economics to do so. So that's it. I know it was a bit technical, but I hope to answer any questions you guys might have. Thank you.
So thank you for that. Actually, we do have a lot of questions. So first of all, are SPACs really that expensive if you take into consideration, even if you ignore the pipe, if you take into consideration that maybe you get better price discovery and so you avoid the pop, right? So if your company was going to pop 20%, but actually you're just getting that price up front and you're just paying a bit more for it, is it really that much more expensive than doing a traditional IPO?
That's an interesting question, and it's an interesting way of thinking about it. I think the question is, do you believe there's going to be a pop and what the dynamic of that pop would be? If you think there's going to be a 100% pop on IPO, first of all, your bankers suck. Second of all, it has to be like a pop of that nature, because it's like what I talked about. The SPAC itself is, you're paying 25%. You need a big pipe to defray those costs, compared to a typical IPO of 7%. So if you have a big enough pipe, and if you believe there's going to be a big IPO pop, then yeah, it could make sense.
So there's also essentially almost the exact opposite question. Is price discovery really that good with SPACs when you're seeing that after the reverse merger, some companies are multiplying by 6? If that's the case,
yeah,
it suggests that perhaps
right.
price discovery is not all that good relative to a direct listing.
I love that. Yeah, exactly right. Well, I mean, the real question is like, what's the steady state of these companies? Like, I don't think, well, apparently some people do, but I find it extremely hard to believe that QuantumScape is at steady state a $30 billion business when it's 5 years out of even commercializing, let alone earning revenue. So, I mean, that's really a question of market conditions. So, but there you go. We've gotten both sides of that debate. I think it's actually very interesting.
And don't you think that Airbnb and DoorDash should have done direct listings? I mean, they left so much money on the table. They would have had better price discovery in the consumer brands. I mean, a SPAC for them probably didn't make sense either, and they wouldn't have raised enough money even with a pipe. No one has, I think, a SPAC big enough to raise billions. But
actually, Bill Ackman's SPAC is $4 billion. So Bill Ackman would have had to do something along the lines of an Airbnb or DoorDash, and that's why everyone's speculating that he might take Stripe public. So he's the biggest SPAC ever. So, right. But do I think that Airbnb and DoorDash should have gone public by direct listing?
Yes.
Well, I think they wanted to raise money. You don't raise money in a direct listing. So.
So direct listing is purely secondary.
Yeah, direct listing. You are connecting existing investors to new investors, and that's why direct listings have to be kind of retail consumer focused. Like, you're not going to likely see a B2B SaaS company go public via direct listing.
Didn't Slack do a direct listing?
Slack is, yeah, but they're kind of consumer facing. I'm talking about like an enterprisey company.
Okay, and so okay, let me ask the question differently then. Do you think that Airbnb and DoorDash's bankers did a bad job?
Bill Gurley would say yes. I say no. I think that these IPO pops are a reflection of extremely frothy market conditions. Let's talk in 6 months when the lockup is expired. I mean, what's the goal of an IPO? I don't think is the goal to maximize every dollar on the table. Then maybe you do like what Google did. You do one of those Dutch auctions. I mean, frankly, I think the price at which Airbnb and DoorDash went public are very rich. So just because the market might be a little manic at the moment doesn't mean that the bankers did a bad job. So I don't think the bankers did a bad job.
Arthur's asking if you think blockchain companies or gaming companies might actually be ideal for SPACing because you have a wait to see expectation for how much revenues are going to come and how disruptive these companies can be.
Well, to be honest, I don't think speculative companies should be going public. So, like, I mean, this is like, now I'm giving my take. Like, if like a blockchain or a gaming company that is unproven, well, like, why are we selling this to retail investors? These are hyper speculative investments. So I'm not sure that these companies warrant being publicly traded.
Which I guess is really what percentage of SPACs like reach end of life and actually don't de-SPAC and like the money is returned?
That's a good question. I don't know the answer, but I know it's very, very small because of those incentives. If you're a sponsor, you really want to get it.
Yeah, because otherwise you're going to lose the fees that and it's millions of dollars.
I mean, you have like, yeah, exactly. I mean, the average SPAC is about $200 million. You're talking $40 million in promote. You really want to get a deal done, and that's why this is powerful.
So after you're done raising FJ Labs Fund 3, should FJ Labs have a SPAC?
It's an interesting question. I think potentially. I think, frankly, if you think about the visibility that we have, I think we have our hands in more companies than almost anyone in the world. Now, the key is that it has to be a blind pool, so we can't go in knowing it. But I do think.
But if we have like 10 companies that we really love more than anyone else, it would be blind, but there's a pool of 10 that would be okay.
And I think that's the key. I think
would be for one.
Do we have amazing late stage access? I think the answer is yes. So do I think a SPAC? Do I think it would make sense for us to do a SPAC? Yeah, I do. And by the way, I think it would make sense if we raise our next fund and we make the fund the sponsor of the SPAC. I mean, that could drive incredible returns to the fund.
Okay. Anything we didn't cover that? I mean, just actually to be very clear, you do think there is a SPAC bubble going on right now?
To be clear, I think there is an extreme SPAC bubble going on right now. I think there are probably some diamonds in the rough, but when you're talking about pre-revenue tomato growing companies valued at $3 billion, you're talking about speculative battery technology companies valued at $30 billion, and an outright proven fraud being valued at $6.5 billion. We are in what can only be described as an extreme mania in this area. And so, like, if you're the retail bro, buyer beware times 100. However, I also want to say that I mentioned I have a tiny position in FirstMark SPAC because I think Rick and FirstMark are amazing. I think that Lux, Altimeter, Dragoneer, Ribbit, I think these are really amazing firms. And if you're a retail investor, you're not going to get access to them any other way. And the one thing I should touch on is that amazing firms, their SPAC will trade at a premium to the asset value. So if you go public at a 10, Altimeter, for example, they've an incredible track record. You actually have to pay $12 for the $10 of value. You pay a premium because everyone knows that Altimeter is so good. So the typical SPAC from one of these amazing investors might trade at $11 or $12 because the market knows how good they are. So it's pretty interesting, by the way, to compare what the different SPACs are trading at, what premium they're trading at. It says a lot about the quality of the sponsor. But of course, then it diminishes your expected returns.
Any questions we didn't cover that we should cover, you think?
Well, I would love to hear if anyone thinks that an amazing company has gone public by SPAC. I think the truth is that DraftKings was in a position of weakness. They were looking to close it just like them and FanDuel when the merger was called off. They were both in positions of weakness. So I don't think their SPAC would be considered an elite one. I think obviously the Supreme Court decision and the explosion in sports gaming in the US has made it an incredible outcome. But I would not say that was an elite.
What about
SPAC.
Opendoor?
I cannot.
I mean, Opendoor is, a pretty amazing company, no?
Opendoor is an amazing company, and I guess you could, and maybe with Clover Health and Chamath, but I didn't get the sense that Opendoor had the extreme hype and momentum that other companies would have. I think Opendoor is a strong company, and I like it, but they were hit by COVID. Their growth was good, but not amazing. There's still a lot that needs to be proven in terms of attach rate for other services. So I'd say Opendoor is a good.
It might be one of the strongest SPACs, though. If I think of the companies in our portfolio in the SPACs, it's probably the best.
Agree. But Opendoor, would you call Opendoor on the same level as like a Canva or trying to think like Attentive or like one of the super hot unicorns? I don't think so.
It's the rung below. I think it can get there, but it's currently the rung below.
Yeah, exactly. I would say Opendoor is like a B.
I'd be more generous. But it's not A+, but I'd say B+, maybe right. A-.
Yeah.
We're not seeing names, but we're saying, oh, this is the one. But okay, I think we kind of covered everything. If people have more questions, you can definitely reach out to Jeff. He's on LinkedIn, and you can put the comments of the questions in the comments section, and we typically answer them. And if not, I'll see you in the new year. Thank you all for being here, and Jeff, thank you for the wonderful presentation.
Thank you. Bye, everybody.